Good evening, traders, and welcome to today's Getting Set session. So this session aims towards acquainting you with the necessary skills as new traders as you embark on online trading. So last time, Mathew covered keeping up to speed with the market events, and he also touched on checking the technicals as you trade. So we will go a step further to look at keeping your emotions in check. So when you talk about keeping emotions in check, the greatest threat towards your success in trading may not necessarily be your broker or the influence of other traders in the market. The greatest threat might actually be you, how you deal with your emotions as you trade. So as previously mentioned in our first class, getting set. The first getting set session that we did like 3 weeks ago, we said that the first step is to first have a structure in place. So we said you need to have a strategy in place through which you can be able to identify opportunities as they occur. In essence, we are limiting ourselves to take trades only when we have a high probability in the market, or when you have good scenarios where we can take opportunities. So we are basically seeking the edge in the market. So you'd want to take a trade only when odds are stacked in your favor. So this will help you as a trader to remain rational and objective, to trade when there is an opportunity. So you'll tend to limit occasions where you may take trades, not because there is an opportunity, but out of whims. So in essence, we are limiting ourselves to take trades when there is high probability. So many traders tend to stray from their carefully designed trading plan, more so after a series of unsuccessful trades. This is often due to the random nature of the market, but it's not due to the fact that your strategy is not working. So long as you have a structure in place, you should stick to that plan so that you can remain on track. So you want to remain on track as much as possible. So it's not every other time that you will have successive winning trades. So in some cases, you might have a streak of losing trades, but that does not mean that you're not in track. So long as you're following the rules that you have set for yourself, then you should be able to stick to that plan all the time. Having a well laid out strategy will therefore help you to avoid wavering. So for instance, times during which the market may be on a bull run, you will notice that some traders will tend to be anxious not to miss out on an opportunity. In some cases, it may not be due to the fact that you've been able to identify trade based on how your rules are, but you may feel compelled to get into a trade due to the fact that you might feel that you might be missing out on a good opportunity. So during such cases, you will notice that you'll be losing your direction. So why we need to have a strategy is to ensure that every time that strategy will sort of help you to remain focused on what you've set yourself to follow in the first place. So it's therefore prudent to keep your emotions in check every other time in order to avoid unnecessary mistakes that may eventually snowball into a full-blown crisis. So in trading, acting on emotions can work against you. It can work against your rational analysis and lead to poor outcomes. So therefore, so long as you know what you need to do, then try to follow that as much as you can. And this will call for a high level of discipline and patience most of the time. So how a trader manages a running trade is just as important as identifying the right setup. So you may be a very good trader. You might be very good at identifying opportunities, but how you manage that trade after executing that trade, then that might actually be the make or break. That is what will determine whether you will eventually make profit and how much profit you make at the end of it. So successful traders know how to manage their psychological state, including taking time off when they are emotionally unstable, so that they can stay at the top of their trading game. So what are some of the ways through which you can control your emotions in the market? So the first thing that you need to have is to have a plan, as we have seen. So every trader is different. And to keep emotions in check, formulate your trading plan based on the needs and the market knowledge. So you need to set your plan in place and you test it over and over again on your demo account so that you can ensure that it will give you good results. So you need to have a decent plan. You will then identify and set up your risk levels and benchmarks on when to enter and when to exit a trade. So it's not just enough to identify that opportunity. Know how you will manage that trade and how you will exit as the trade continues to make profit. From time to time, you will also need to revise your plan so that you can ensure that it's working effectively. So for example, you can take or you can download your statements for a period of 3 months or the last 6 months and try to review them so that you can then assess how that strategy is working in different market environments. That way, you'll be able to improve and know which markets or which situations fit best that strategy. The other thing that you need to do is to filter market noises. So emotions kick in due to a huge amount of information which is disseminated on a daily basis in the markets, mainly emanating from various sources like the media, like TV, internet, or even information obtained from other traders in the market. So you should know that it's not all information that is inconsequential. What separates low performers from high achievers in trading is how well a trader is able to filter necessary information from the noise. So you need to know which information is relevant as you trade. And the beauty is that in financial markets, we have an economic calendar. So that calendar gives you, or it tends to highlight various events that are likely to affect the performance of various assets. So acquainting yourself or familiarizing yourself with the calendar will help you to know what is likely to happen. So for example, if you have economic data release relating to euro, pound, and Swiss franc today, then it means you have to know how those events turn out so that you may be in a better position to know how the performance of those three assets will be later on after the release of those events. Lastly, the other thing that you need to put into consideration is to act logically. So logical thinking can help you keep a tight lid on your emotions. So when you think logically, you will tend to make rational decisions that help you to reap profits. So you need to avoid emotions and make decisions based on logic. Always question yourself as to whether your decision is emotionally driven or whether it is backed by solid fundamentals. So the reason why we are setting a plan is to help us make decisions out of logic. You want to keep your emotions in check all the time. Then the other thing, or the other point that you need to put into consideration is to avoid overexposure as you trade. So when you talk about overexposure, you will notice that financial exposure is a case where you'd have, or it is basically a case where you'd have certain assets behaving either in a similar manner or in a completely opposite manner. So successful traders tend to, it should be, you should from time to time monitor how various assets behave in relation to each other. So with correlation, we are trying to measure how assets value change in comparison to another. So we are trying to gauge the statistical measure of the relationship between two financial assets. There are two types of correlations. Sorry, there are three types of correlations. There are assets which are said to be positively correlated. So a correlation would range from -1 up to +1. So a correlation of 1 is a case where you'd have prices of two assets moving in the same direction almost perfectly 100% of the time. We may also have a negative correlation. So a correlation of -1 implies that two assets are in most cases moving in the opposite direction almost 100% of the time. Then when we say that an asset has zero correlation, it means that two assets are moving randomly. There's no correlation at all. So we have such assets in the market, and as a trader, you have to be careful as you trade such assets. So the charts which have been projected here are the charts of euro dollar and USD Swiss franc. So these are daily charts, and they are showing the period between early February 2020 up to mid-February 2021. So when you look at these two assets, what comes to mind? Just take a moment and observe these two charts. So if you look keenly, what you will notice is that when one asset was on the rise, the other asset was in most cases on a decline. And when the other asset began to rise, you'd have the other asset declining. So if you are to trade these two assets, let's say between the period of early July 2020 up to the end of July 2020, so we are talking about this period. So starting from this time up to this time. If, for example, you were to get into a buy position of euro dollar within that period and a buy position of USD CHF, what you will notice is that at the end of that period of 1 month, euro USD buy position would have given you profit. On the other hand, USD CHF sell position would have given you a loss. Now, the fact that these two assets are moving in the opposite direction most of the time, what we would refer to be negative correlation, you will notice that when euro dollar is giving you profit, that profit would, on the other hand, be wiped out by the other trade. And the fact that they are almost perfectly negatively correlated, and this is to mean that when one is on the rise, the other one is moving on the opposite direction almost perfectly, then it means that if you are in a buy position of euro dollar in a sell position of USD CHF, it means that having those two positions at the same time, you're almost in, it's like you're in no position at all, because the profit that you'd make on euro dollar would actually be eaten out, or it would be wiped out by the other trade. So with such assets, or how you're supposed to approach such assets, is to only take one position. So in this case, instead of taking both positions at the same time, you're better off gauging between euro dollar and USD CHF to determine the opportunity or the trade that would give you the best chance in the market. So if you're acting on the basis of a weakening dollar, then it would be more prudent for you to measure the movement in euro and the movement in Swiss franc to determine which between those two would have a chance to strengthen than the other. So if, for example, you are to have euro strengthening at a higher rate than Swiss franc, then you'd be way better off taking a euro dollar buy. And ignore taking USD CHF to buy. Similarly, when you check these two assets, you will notice that they are moving in the same direction most of the time. So when one was on a decline, the other one was on a decline as well. When one began to rise, the other one also was on the rise most of the time. So when you have two assets moving in the same direction, almost perfectly, we refer those assets to be positively correlated. So again, when you have such assets, the best decision to take is to take a trade in the asset which you feel would give you the best chance to make the most amount of money. So in this case, instead of taking a buy position in Aussie dollar and a buy position in New Zealand dollar, US dollar, you're better off taking one position, a position in one asset, the asset that has the best chance, since by taking two positions at the same time, ideally you'll be exposing yourself to too much risk. And that is what we are trying to avoid. So basically, that is all we had for today. So I hope you've been able to learn something and you will put it into good use. So at this point in time, I wish to bring this session to an end, and I hope to interact with you in our future session on. So we will have the next session this coming Wednesday, and we will be covering how to spot opportunities in the market. So we'll look at a very simple technique and how you can identify when the right time is to trade. So I look to meet you this coming Wednesday at 8 p.m. So have a good night.